welcome to the July call, which I think is quite timely. How will the upcoming U.S. elections affect the stock markets, which we're going to dive into first, and then we're going to have a little peek at the Canadian economy. So let's get started. Anthony, how do I scroll down here? There. Okay, the arrows aren't working, but okay. So this is again looking a bit in the rearview mirror, and we like to look through the front windshield. But this is as of yesterday, and these numbers are changing dynamically. There's been quite a lot of things to share with you that have changed in the last couple of weeks. But we're sitting Dow Jones, which is the 30 stocks of the Dow, plus 5.7. And again, this number's changed today with the Dow up. S&P 13.7. The NASDAQ being kind of the leader at 15.5, technology late in index. Toronto Stock Exchange 8, the Russell 2000 8.5. Interesting that that's up 2.5% today. So this is yesterday's number. So we're up close to 11. The poor bond holders, this is the long bonds, minus 6.6. We're going to dive into that a little bit more. Gold 16, although down today. Canadian dollar minus 4.1 versus the US dollar. Canadian preferreds, which you know we have liked, 13.1. In fact, interesting little tidbit, we'll go through this in a moment. We're running about 3.3 of dividends, that's just the price point. So in fact, the winner is not NASDAQ or gold. The winner is Canadian preferreds on a total return basis. U.S. crude oil minus 5 for the year. Let's get into what to expect on a U.S. election. Now, this headline was as of Wednesday the 17th. And since then, things have changed dramatically because we've had quite a sell-off in the technology shares and the U.S. indexes. But investors ride the Trump trade as expectations grow for a second term. Well, this is, Trump was going to win. It was going to be Trump versus Biden. And things have changed dramatically. Why would the market celebrate Trump? I thought the markets were really volatile. Well, let's remember, we are investors in companies. One of the things Trump stands for is lower taxes on companies. We invest in companies and we receive earnings that are after tax. If taxes go up, our earnings go down. So on the surface, and again, this is on the surface, Republican Trump tends to be better than Joe Biden, who was campaigning on higher corporate taxes. Let's talk about what does happen in election years. And we started the year by saying election years are good for stocks. And so far we have, it's been a very, very good year, not 2021, but well above average in terms of what we have earned for our clients. Now, I want to show you the black line in the middle, which shows the markets doing very, very well up until the end of July, which is where we're at. And then you can see that line from about August 1st till the election on November 1st. Well, the election has happened early November, first week. But you can see the markets zeroed out. Now, this is the black line. So this is the all election years combined. But there's a very different outcome depending on certain factors. So number one is the green line. The sitting president is running. Now, think about this for a moment. It doesn't matter whether he wins or not. The sitting, like Trump lost his second term, George Bush Sr. lost. But the markets seem to, if the current president is running, the markets continue their advance from August into the election. If, however, it's an open field, meaning you've got two different candidates, the markets actually do very poorly, not very, but, minus 4% is not very. But on average, we have a declining markets between now and the elections. And I got to say, this might be clear as mud because is the current administration still running? Because it was Biden-Harris. So if Harris wins, which is the assumption, is that the same as a sitting president, which you would say? Conversely, Donald Trump has already run. So is he an incumbent? Is he a sitting president? Well, sort of. So you could kind of, after the fact, say, see, I told you, go back to this chart, and no matter what happens, you could say the chart predicted it. So it's kind of clear as mud. If you have to ask me, I think that the open field, which is the dotted line, is the most likely outcome. And I say that because I think that there is a lot of uncertainty because I think Harris is a different person than Joe Biden. She's from California. She might be friendlier to large cap technology. I don't know. We'll find out how progressive she is, how much taxes. As investors in capital markets, we're not in favor of taxes. I mean, again, you might be on the side, but we're just talking about investments here. So I'm going to keep going on this topic. I don't really have a clear answer. I will tell you that I think the worst single economic policy would be a trade war and tariffs. So don't think that I am in favor of a president that his number one policy is to attack more tariffs. I think that this will be a very bad outcome for the world and creates a tremendous amount of uncertainty. So I think that is, be careful. I think the other two terrible policies are higher taxes and big deficits. And Joe Biden has failed miserably in the last year with a strong economy, almost record low unemployment, and a deficit running north of 6% of GDP. It's reckless. It's bad policy. I will give you another Republican or Democratic bad policy. I think one of the historically the worst policies, and it seems like a good idea, is rent controls. And actually, Harris and Biden are running on a national rent control agenda, which I think creates housing shortages and ultimately leads to higher rents, not lower rents. And it also leads to below market rates, which then you can create ghetto slums because there's no incentive for landlords to keep up when they keep up the buildings. So again, I think that there's some bad policies with both parties, but that's me, and I'm talking about history and looking forward. One thing that we know based on history is the markets, and we've got a taste of this in the last week, are about to get a lot more volatile. The VIX is the volatility index, and it measures the degree on a daily basis how much stocks are swinging around. So historically, a VIX of 14 is low, but you can see that ramp up into the election, and then once you get the final outcome, you could see July, August, September, October, right into the election month, volatility increases. So this is highly probably going to happen. So buckle your seatbelts. You're going to see some swings up and down. This is the last week, and again, markets are up a bit today in the S&P. But the S&P in the last week, since that article was published about, it's Trump's going to win, and that markets are celebrating that. Well, that's changed dramatically on the uncertainty of what's going to happen, and the markets have corrected a few percentage points. That's year to date on the S&P 500. Now, I want to point out something which is really, really incredible. I said last year that the bubble in technology was not as great as the bubble of the internet bubble of 1999 that flooded into early 2000. And I have to be careful because that was said last year. The Magnificent Seven, which is a phrase coined by Jim Cramer on CNBC, but seems to have stuck. These 7 stocks are representing more than 30% of the value of the S&P. They were up collectively up until July the 10th. They were up collectively 49.9% for the year. So if a third of the index is up 49%, if you do the math, the S&P is up 15.5. All of the return was coming from 7 stocks, and the other 493 were zeroed for the year. Very, very interesting. This is interesting because the Russell index is up 2.5%. This was printed yesterday. So we have the Russell, if you look at the left side, up until early July and into the first week of July, the Russell index of 2,000 stocks, and as an aside, it's never 2,000 stocks because there's always an acquisition or a merger with these 2,000 companies. So I believe it's 1,982, but it's called the Russell 2000 index. That index had done zero for actually almost 3 years. And year to date, up until early July, it was zero. The Mag 7 has corrected 14% in 10 trading days, and the Russell 2000 index has gone up 10.5% in the last 10 trading days. So let's not, I hear a lot of the markets are in a bubble. I don't want to invest in the market. We have all kinds of different markets, and the Russell 2000 was looking nothing like the NASDAQ or the Mag 7 or the S&P. All right, so let's talk about, this may be the scariest chart for technology investors. This shows the S&P, the concentration of the top 10 companies. And we can go back and look, 1929, we can look back at the internet bubble. So if we look at the top 10 companies, we see that they were representing in the tech bubble about 28.5, 29% of the S&P 500. And if we look back, we can see these patterns go back into the 70s. There was people just said the Nifty 50. Somebody figured out that if you just bought these 50 stocks, that's all you had to do. You could retire with comfort. Well, guess what happened? Everyone jumped on this trade, and the Nifty 50 became so overvalued relative to every other stock that failed. We have tied the 1920s bubble. Now, just think for a moment. I'm going to ask a skill testing question. What mania was around in the 20s? What's the music from Jeopardy? Okay, and the answer was the automobile industry. General Motors went from $9 to $111. And the biggest companies were going parabolic. We started the decade of the 1920s with 3 million cars on the road. We finished with 29 million cars. It was the new technology. It was very exciting. General Motors, Ford wasn't public yet, Chrysler, BF Goodrich, it was Bethlehem Steel. Anything to do with automotive production was going nuts, and that was an indication that that particular sector, when you see that kind of concentration, watch out. The internet bubble, and the internet again. By the way, there's 290 million cars in the United States. So the investors in cars got it right. Unfortunately, they lost most of their money. Let's talk about the internet bubble. The internet was just being vented in the late 90s. It was a new thing. People caught on. It was going to be huge. It is huge. It was bigger than we possibly could have imagined. And yet, this chart gave you the warning sign that that was a problem. Today, it is artificial intelligence, AI. I'm not sure that artificial intelligence is going to change the world as much as the automotive industry. And I'm not sure artificial intelligence, the young guys will call me up and my 35 and 40-year-old clients, and they, I'm an old fuddy-duddy, they'll tell me if I'm right or wrong. But I don't think that AI, we'll see how much profits. It's incredibly expensive to implement, and we'll see what the return on equity. There's some excellent interviews if you want to Google an interview with Roger McNamee on CNBC about the return on AI spend for the businesses that are, just kind of scrambling to spend. But a scary chart, and be careful because the valuation, I can no longer, as I said last year, that the internet bubble wasn't extreme. It is now. Further evidence of the bubble that exists in technology. This is, as you know, many of you know that we are avid followers, and we pay for this service, but we are avid followers of Ted Dixon's research on insider activity. Now, insider is, I'm not talking illegal insider activity. I'm talking about CEO of a company or a chairman of the board who are buying and selling their own shares. And, here we are with, the biggest, fastest, best companies that all you need to own is these companies. And this is just 1 week. And I can tell you that the selling of these companies has been relentless. Oracle, NVIDIA, Amazon, Uber, Meta, that's just 1 week. And it's in the tens of millions, if not hundreds of millions of dollars on a monthly basis of selling. So if they're so great, why are we selling? Good question. So I'm going to summarize at the end, but the stock market is not a market that all is moving together. We've got a bubble in a sector, and we've got another sector which is now just playing catch up, where there is excellent valuation. I can tell you that, in terms of the Russell 2000 has, on 2,000 companies, about the same value as Apple or NVIDIA. Now let's look at Apple. Trades about 36 times earnings. The Russell 2000, the profitability of those companies is 2.5 times greater than Apple's. Yet the value of those 2,000 companies is the same as one company. It's kind of skewed in favor of the 2,000 companies. All right, let's talk about Canada for a moment. Bank of Canada cut rates yesterday. Hallelujah. And they say more are coming. Okay, so great news for people that are in debt. Now, if you had inside information at the beginning of the year, the Bank of Canada was going to cut rates twice, and they would signal that they're open to cutting more times. Wow, let's buy long-term bonds, which are the biggest gain we can make if rates go down, bonds go up. Well, what's going on here? You bought the long-term Government of Canada bond exchange traded fund, ZFL, on January 1st, you're minus 6.6%. What's going on? And the Bank of Canada yesterday lowered rates, and bonds fell in value. Not went up, fell in value. Well, let's talk about what's going on here. The bond market are not, bond investors and the bond market is not stupid. They did not wake up and went, what? Bank of Canada cut rates. Oh my God, I had no idea. These get factored in beforehand. And the bond market, so far this year, has got it wrong. Because the bond market, the investors in long-term bonds, had overly anticipated how many rate cuts were coming. So this is a very important thing. It does not mean the bond market was at some point reflecting a return to the good old days of zero rates, and that doesn't look like it's going to happen. You know, as bonds have fallen, we have told investors we don't like bonds, but we like preferred stocks. And here we are, the market, the Mag 7 lost 15% of their value in 10 trading days. And the Dow was down 500 points yesterday, and the preferred shares continue to rise in value. Again, we're up over about 16% year to date, including dividends. Well, what happened in June there? Well, it's interesting. Do you remember we had a new tax coming for the wealthy and for corporations? Well, there's a lot of plumbers and welders and drywallers that have dentists, that have companies. And the best place to have put, because it's so punitive on taxation for interest, they wanted to be safe. A lot of people own preferred stocks. And lo and behold, these preferred shares were going up and up in value. So their accountants called them and said, maybe you ought to take some profits and take those capital gains. So the preferred share index bottomed on June 17th. The culmination, the deadline was June 25th. So you had to have sold before and settled your stock by then. So you had a Christiana Friedland, I'm going to take profits. And then, of course, the selling dried up, and we corrected all the losses of thanks to Christiana Friedland. And by the way, because capital gains have been increased in taxes for our business owners, it makes dividends even more attractive. And ironically, it is more and more capital is going to flow towards the preferred market. So should we sell now? Wow, we're home run trade. Well, let's remember that preferred shares, these are preferred shares that have recently, as I said, every 5 years, there's a new dividend. And that new dividend is based on a formula. And the formula is, maybe it's Enbridge T, 2.5% plus the 5-year Government of Canada bond. Well, the 5-year Government of Canada bond went from 2.5% to zero almost in COVID, but now they're up over 3%, about 3.25%. So Enbridge T had to raise its dividend almost 50%. So if you look at the current price of Enbridge, TransCanada, Pipe, BCE, these are preferreds that have recently reset, and this is the new dividend. Guys, this is unbelievable. You can get dividend yields of 7.5% by diversifying in these 5 businesses, and your dividend is reset. I get that for the next 5 years. If I'm right, you're probably going to get another dividend increase in 5 years' time. And, you know, a lot of clients, one of my clients, just wonderful guy, great investors, sharp as a tack. Talked to him even a few months ago, just passed away at 96 years old. He's one of those guys you thought was going to live forever. He was so smart. He became a client in the 90s because we bought. This is when rates were high. He came along and I told him, let's buy some BC savings bonds. Well, these don't exist anymore. You get 7%. Your rate was guaranteed for 3 years. You could cash them in anytime. What a great investment, 7. I'm telling you, those were fully taxable. You can check with your accountant, and everybody's different. If your income's under 100, this number, 100,000, these numbers are even better. But 7.5% with a dividend on a company or at a personal level is the same thing as about 10.2 on a GIC. So we are near 30-year highs on this particular sector of the market. Now, why do I think that's still a good place to invest despite the fact of how much money we've made? Well, one by one, the banks are eliminating their preferred stock. And in the last 2 months, $1.5 billion has been called in. And that capital, a lot of preferred shares are in the hands of exchange-traded funds or mutual funds, and they have a mandate. So when that capital comes in, they have to redeploy it, and they put it into other investments, other preferred stocks. So that continues to propel. So we had 1.5 billion that just keeps pushing back into the existing stock of preferreds. Yesterday, or 2 days ago, they announced, Bank of Montreal, that they're calling another 400 million preferred. Well, we've had a string of announcements of preferred shares that are going to be called. And in the next 2 months, 2.5 billion of capital, which could be a record on a 2-month basis, and there's no new stock available. So we have preferred shares all trading under their par value. Par is $25, all under their par value. And what an opportunity, because we can collect our yields. And if I'm right, the shares are going to go higher. Now, people say, well, why don't you buy those Bank of Montreals that were called? The market had already anticipated this. The Bank of Montreal preferreds went up 9 cents. Ironically, our Enbridge preferreds and our TransCanada and our Brookfields are going up far more than that. You call the Bank of Montreal preferred, and the winners are Enbridge and Brookfield. Okay. Some of you might say, Dave, I own the Enbridge Ys. I own the Fortis Ms. These were reset under the old rules and the old interest rates. Hang tight. These are all preferreds that are in the near future are going to have dramatic dividend rises. We can go through the math, but the best opportunity to make money is to buy the ones that haven't reset their rates, where it's not showing up. As soon as the dividend is announced, people see it on their screens and they start buying. But the sleepers are the ones where they're going to reset late this year or next year. I want to just go into another bubble indicator. When the markets, we talked about the election cycle. This is the weekly survey of the American Association of Individual Investors that are surveyed on a weekly basis. And I want to show you that the latest survey showed that the 52.7% of the market was bullish, 23 neutral, and only 23 bearish. When that number spread gets near 30 points of spread, you can see a few lines below. I've highlighted historical average is 37% bullish. So we're way above that, and we're way under the historical bears. When you get near a 30-point spread, watch out. This is a dangerous amount of complacency. Like I said, in a swimming pool, if all the patrons are in, the water level's about as high as it's going to go, and you're vulnerable to some negative shocks. So a little bit of a warning sign. This is another sentiment survey. This is Investors Intelligence, which measures the leading newsletter writers. So you subscribe to a service. Now you can see that the red line shows the amount of people that of professional, expert advice givers are bullish of the markets, and the blue line is I'm negative on the markets. You can see that the spread is near the warning signs. Now, again, I will warn you that red line spread, if we look at 2017, 18, you could stay at those spread levels. You can see during the October of last year, when interest rates were going to go to the moon, we didn't know how high they were going to go. The experts got very negative. It was an incredible buying opportunity. You can see in 2020 in COVID, the experts told you to be careful. The bullish numbers plunged, and the experts got very negative. And you can go back and you can see in the early 2000s, the financial crisis, the Greek almost default. You can go back and you can see every time there's a headline that's negative. The problem is we have no negative headlines today. So just a little bit forewarned that there's a little bit too much complacency in this market. Again, I am not predicting the sky is going to fall. I think there's plenty of value, but surely the major indexes, the tech bubble is certainly vulnerable from that perspective. Going back to Canada, be careful of Canada. We are now seeing retail sales. We're seeing a lot of the employment numbers are deteriorating. The most important industry in Canada is construction business. We have no companies like Microsoft or Amazon or Boeing even. We have American companies that manufacture here, but we have, this is our number one industry. Yes, some people think it's oil and gas. This is way more important. What do? We borrow money and build condos. Sales of new homes, pre-sales condos plummet in the GTA. I can only drop the price so much inside of one condo owner's desperate attempt to sell. People are sitting there and they go, I paid $670 for my investment property. I can't sell. Okay, there's a point. Thank you, Ben Rabideau, for his excellent research, which again, we get, and we can, use his data. New condo sales in the greater Toronto area, and we're seeing similar data in Vancouver, have plunged are down 72% below their 10-year average. Now, what Ben has done is he's lagged the housing starts number. Because again, what do? We build condos. We're building a record amount of condos. Everybody's employed, new immigrants. We don't have enough people. We need to keep bringing people in to build condos. We're near record. But as a builder, there's a big lag between sales and putting a shovel in the ground. And that's permits. The other thing you have to do to get financing from a big bank is you need to pre-sale 60 to 70% of your units. So with the plunge in sales, what Ben is showing is that these are absolutely correlated. If you can't pre-sell your condos, you are not going to go ahead. So new condo sales, we are 1 year to 18 months away from a collapse in building. That'll be very interesting to see. Let's remember, there's two things that can derail the housing market. One is high rates, and the other was I've lost my job. If you're not working, you can't pay your mortgage on the unemployment insurance check. I've said a few times that the bond market has already anticipated. We tend to see about a 2% spread between mortgage rates and the 5-year bond. The 5-year bond is already at 3.25. The Bank of Canada has lowered to 4.25 from 5. So we've already dropped. Well, the bond market got, as I said, has already priced that in. When the Bank of Canada's finished raising rates, the 5-year bond is typically 0.75% above the Bank of Canada rate. So we've already priced in the Bank of Canada going down to 2.5. I don't think there's that many rate cuts, and I don't think there's that many rate cuts because the US, although they are going to start cutting rates probably in September, it's higher for longer and slower. And that's because the US economy is not falling off a cliff. They're going to normalize rates. They're calling neutral rates 3.5. That means your bottom of rates is still, way. Bank of Canada can't go to 2%, and the U.S. is 3.5 to 4, and that's because the Canadian dollar gets way too weak. And if we aggressively cut on our own, the Canadian dollar lets go, and then actually rates, 5-year bond starts going up. So if we're not careful as the Bank of Canada and we get reckless with rate cuts, 5-year interest rates are going way higher, not lower. So 5-year mortgage rates are kind of stuck around 5%. 5 is, by the way, I mentioned this once in my, when Richardson Greenchills got bought out by RBC and LePoidevin Group was at RBC, I was really upset. I didn't want to work for RBC, but we got a staff mortgage rate of 4 3/4. 4 3/4, that's free. I was so excited about that. And mortgage rates were 7 at the time. I don't think 5-year is 5% 5-year is particularly high. But if you have a mortgage that was at 1 3/4, it's going to come due. Again, in the next 2 years, it's going to be unbelievable. This is when mortgage rates really start coming due. And next year and the next 2 years where the COVID rates, people's mortgages are going to go up 50%. The Canadian economy is going to suffer. Construction jobs are going to be lost. So the Canadian economy looks very, very weak. And I think it's, be careful of Canada from a credit perspective. Not preferreds that we're buying, but be careful of Canadian credit, the Canadian dollar, and a lot of people are going to get burned. Just as an aside, LePoidevin Group, we have a playbook. We have unbelievable traders. Thank you, Anthony, Aaron, Susanna. Unbelievable work because we buy blocks of stock. They allocate individually. RBC client says he lost $30,000 in capital gains savings after the firm was unable to sell his holdings. When you're at one of my zombie competitors, you have a model. Everyone has the same permutation of stocks. And the client says, I want to sell these stocks. I want to crystallize my gains. You can buy them back tomorrow. They're not able to do it. You're in a model. That's a hard fact model. You could sell the whole model, but there might be some losses in there that you didn't want to take in advance of these gains. So again, thank you for that. We have individualized services. It's way more work. It produces better returns, and it produces a far higher and greater after-tax return. Okay, to summarize, I think that the investment opportunities are excellent in select areas. Be careful of the momentum trade. We have much smaller exposure to large cap technology. I'm far more interested in all the other companies that are just playing catch up, that represent very good value. Again, the playbook. Almost every new client that we see come in has some kind of alternative investment funds. The funds that are exposed to real estate are gating fast and furious. Gating means, don't worry, Mr. Client, you haven't lost any money, but for a little while, you can't get your money back. You cannot sell it. Get out before that happens. It's happening all over. Builder loans are blowing up. It's going to get far worse. And be careful of that. Just be careful. Be careful of, there's a lot of credit strategy investments. There are some good. We don't play in this space, but a lot are going to have exposure to builder loans. So you need to do your homework. Do not invest in GICs more than $100,000. I was around in 91. The playbook is 1991. 100,000. We experienced it with not only our clients, but clients that had accounts elsewhere. had more than 100, back then it was 60. It's now 100,000 of deposit insurance. We are going to see, I don't know who, wish I could give you the playbook. We are going to see some second tier credit unions, trust companies, banks fail. So be careful. Here's our disclaimer. And that's kind of it. Thanks everyone. I think I answered a few of the questions within the call. As always, send us an email if we didn't get to what is particularly interesting to you. Market's vulnerable, but we're going to stay invested. The sky's not falling, but we do have election uncertainty coming, so it's going to be more volatile for sure. Thanks everyone. Thanks for tuning in, and we'll talk to you next time.